Today, I'll share with you 3 of the highest Canadian dividend yield stocks that you can find on the stock market and that are all giving over 6% of dividends to their shareholders per year. So obviously, the main criteria that I've checked when I've picked those companies is to see what are their big juicy dividends, but I've also took a look at what is their business model, so how are they able to generate their income, because even if companies are proposing a 10% dividends to their shareholders, if they are not able to generate enough income to cover this dividend, they won't be able to fulfill their promise. So without losing too much time, let's take a look at my pick number 1. The first company on this list is one of the greatest of all time dividend aristocrat here in Canada, and it is the company Enbridge with the ticker ENB. This energy company is one of the world's largest of its kind, and it is the largest here in Canada, and at the same time it is giving a massive juicy dividend of over 6.50%. On their part, their main job is to distribute and transport energy of all kinds, going from the oil to the natural gas and to the natural gas liquid, and also to the renewable energy all around North America. In fact, they currently move about 30% of the total crude oil production here in North America. They also transport about 20% of all the natural gas consumed in the US, and they operate North America's third largest natural gas utility by consumer count. As you can see, those aren't some rookie numbers, and it is why Enbridge has a valuation of over $100 billion at the moment. Plus, if you're looking to invest in a renewable energy, Enbridge could be a great option on that side as well. Indeed, they've recently worked a lot on the renewable energy branch, where they have the net zero gas emission policy before 2050, and at the moment their green energy production is enough to meet the requirements to power over 968,000 homes all around the country. So it is a very interesting company if you want to enjoy both the benefits of an oil company, which can protect you against the high inflation, while also enjoying the pros of having a great renewable energy company in your portfolio, meaning that you could obviously enjoy the potential benefits of this massive important transitions that will come in the next century. But now let's see what the fundamental metrics are telling about this company to see if it is currently over or undervalued. In valuation terms, we can see that this company currently worth about $108 billion, however with a quite high price to earning ratio of about 41, which is showing that this company would currently be overvalued. Despite that, over the last 12 months, we can see that they've been able to generate some interesting profit and operating margin, as well as an okay return on equity of close to 5%. And over that period, they've generated some revenue of about $53 billion, with some growth of about 7% in their latest quarterly revenue. But unfortunately, you can see that they currently sit on only about $1 billion of cash compared to their massive debt of close to $82 billion. And in terms of the volatility of this company, represented by the beta on a 5 years period, we can see that this company is slightly less volatile than the overall market, with a beta of about 0.88. But over the last 52 weeks, you can see that it has lost more value compared to the market, where it has lost close to 5% of value compared to the market that has been down of only about 1%. Plus, Enbridge, as I told you earlier, is giving a massive 6.65% of dividends to their shareholders. And in their case, to see if the dividend is sustainable, we won't be using the classical payout ratio, but in their case, we'll be using the discounted cash flow payout ratio, which is always between 60 and 70%. Jumping now to my second pick, which is Fiera Capital with the ticker FSZ. Fiera Capital is an independent asset management firm that has a growing global presence all around the world, and at the end of 2022, it had about $160 billion of assets under management. This makes it one of the largest Canadian investment managers that is also giving a massive 11% of dividends to their shareholders. Their business model mainly focuses on delivering great customized multi-asset solutions to their different customers, and those solutions can come from the public or the private market asset classes. This means that they are working as some usual financial advisors with the objective to find the best investment vehicles for their different clients, but most of the time their different clients are some wealthier people than the average customer. Plus, the big pros of these kind of businesses is that they are not controlled by banks, meaning that they can offer a wider range of different products and services, because most of the time when you're going to see a financial advisor from a certain bank, this financial advisor will only propose to you different products from its own bank, but on their side, this equity market company is able to offer to you a wider range of products, as I told you earlier, for example, some Canadian and some foreign equities, as well as some bonds, and most most importantly, non-traditional assets. In fact, someone that has $20 million of assets won't want to have the same approach as someone that has $20,000 of assets. And so these kind of firms can offer some great non-traditional assets to their customers, such as real estate, commodities, private equity, private credit, but also different hedge funds. And on their side, Fiera isn't only targeting the Canadian market, but they are also going in all the North American market, Europe, and some targets in Asia. Plus, as any asset management firms, they will be making the biggest part of their income throughout a certain commission that will be applied on their total assets under management. And as you can understand, the total revenue of this company will be directly correlated to the overall stock market performance. Because in fact, if the market performance is increasing, it means that the total assets under management of this firm will obviously increase, meaning obviously that they'll be able to generate a lot more income. But on the upper end, if like in 2022, the overall stock market has been decreasing, well, in the last quarter of 2022, we can see that their total revenue and their total net income has been diminishing compared to the same quarter, but in 2021. But now, let's make a quick fundamental analysis on this company. As you can see, Fiera Capital currently has a quite lower market cap compared to Enbridge with a valuation of about $772 million. But the good news is that it currently has a lower price-to-earning ratio of about 31. Over the last year, this company has been able to achieve some pretty fair profit and operating margin, as well as an excellent return on equity of about 8%. And over that same period, you can see that they've been able to generate some revenue of close to $700 million. However, with a quite significant diminution in the growth of their latest quarterly revenue of about 24%. And the scenario was pretty much the same for their latest quarterly earnings growth, where they have been diminishing of about 93%. And one major problem that I see with this company is the total of cash on which they currently sit on of about 70 million compared to their debt that is about 10 times bigger than it. Add to this, you have a company that is quite more volatile than the overall market with a beta of 1.41 and with some loss of about 22% of its valuation over the last year. And so why did I pick this company is mainly because of its massive dividend of about 11% that they are still able to pay, but maybe in the future they will be forced to cut it because of their super high payout ratio of over 300%. And finally, for the last best Canadian high dividend yield stocks that you can find here on the stock market, I've decided to include the company TransAlta Renewable with the ticker RNW. This business is another big energy company just like Enbridge that however mainly focus its efforts on the renewable energy sector. Indeed, while Enbridge is mainly focusing on the transportation and the production of fossil energy, RNW is one of the largest generator of wind power here in Canada. However, compared to the massive valuation of Enbridge of $100 billion, this company worth a lot less with a valuation of less than $5 billion. Nevertheless, this company is giving a massive 7.50% of dividends to their shareholders. Plus, at the moment, TransAlta Renewables portfolio consists of about 48 energy facilities all around the country and in the US, and it notably includes gas, hydro, and wind turbines. Despite all of these great news, when you are investing in this kind of company, you are more investing in the future compared to the present moment. Indeed, as you can see by its price fluctuation, you can see that this company has gained a lot of momentum and a lot of value at the beginning of the pandemic. But since 2022, we can see that this company has lost a lot of value, notably due to the overall market crash. Regardless, since its inception on the market in 2013, you can see that this company has been able to grow their dividends every single year. And the great news about that is that their massive dividends is able to offset a certain part of the losses of the overall diminution of their value. But now, let's see what the metrics are telling about this company. In terms of the valuation measures of TransAlta Renewable, you can see that their market cap is slightly higher compared to Fiera, but it is still way lower compared to Enbridge. And you can see that at the moment, their price to earning ratio of 45 is quite high. But despite that, over the last 12 months, we can see that they have achieved some incredible profit and operating margin with a pretty fair return on equity of close to 4%. And for that same period, they've been able on their part to generate about $560 million of revenue with a growth of about 12% 12% in their latest quarterly revenue and a diminution of about 7% in their latest quarterly earnings. And just like Enbridge and Fiera, this is another company that doesn't have a lot of cash compared to their current debt position. And over the last year, despite being a company that was less volatile than the market on average, you can see that over the last year it has lost close to 30% of its value. But despite that, just like the other companies on this list, you can see that this one is offering a massive dividend of over 7.50%. But just like Enbridge, we can't use the payout ratio to evaluate if the dividend is sustainable on the long term. As you've been able to see in this video, the Canadian market is full of great high dividend yield stocks that are mainly focused in the energy and in the banking sector. But on your side, if you want to discover another great Canadian stock that might be the new SpaceX, well, check out the video that's gonna be right over here, and I will see you soon. Peace.